Okay, I had welcome. I had explicated a SIE 75 question practice exam and received some positive feedback on that. And so the request was, could I explicate another practice exam for the Series 7? So the answer is yes. And that's what we're going to be doing. Now, explication means when we explicate something that we're not really doing what we're usually doing in a practice exam, which is inventorying your intellectual Series 7 skills. No. What we want to do is go through the questions and talk about the right answers and the wrong answers. You know, the technical name for a wrong answer is a distractor. And we want to talk about, distractors and when they would have been right answers and things like that. Now, unlike the actual exam, which gives you a balance of easy and difficult questions, I've got some real difficult questions in here. So, you might want to circle back depending on where you're at in your study effort. If you haven't watched, for example, all 4 option lectures that takes you through all the 9 option strategies you're held accountable for, you might get in over your head when we get some option transactions here. So, oh well, it's taped, so you can stop it and rewind or come back to it whenever you'd like. That being said, please remember that because some of these lectures are pretty long. I mean, I don't feel compelled to chunk them up because I figure you can chunk them whenever you need a mental break. You can just hit the pause button. All right, so let's explicate this exam. Give me your feedback. If you'd like to do this, another one of these in the future, that would be fine with me. So let's get started on explicating a Series 7 practice exam. All right, number 1. Which of the following has no voting rights and pays no dividends? Which of the following has no voting rights and pays no dividends? I give me my annotation tool here. And that's going to be Treasury stock. Now, all of these could have been a right answer to a different question. If they would have said on your exam, what is the maximum number of shares a corporation may issue under terms of its charter? Well, then the answer would have been A. If they would have said shares that have been placed with investors, well, then your answer would be B. As we said, the answer here is C. Outstanding stock. Outstanding stock is issued less Treasury. Issued less Treasury. All right, number 2. Who cancels old certificates and issues new certificates? Now, you should have been able to get this to a 50-50 pretty quickly. We don't allow the issuer to effect change in ownership. And so the person who effects change in ownership is the transfer agent. The registrar maintains the shareholder. Now, most of the times that's the same commercial bank. But if I would have said who maintains the shareholder list, the answer would have been A. If I hear the answer once again is B. B as in boy, the transfer agent. I'm seeing my annotation tool. By the time I get it out and clean it up, I think that's just going to slow us down. So I'm not going to do that. I'm just going to go ahead and tell you what the answers are. If you want, just, when you watch the video, put in the comment box if you'd like, and we'll figure out a way to get you an answer key if you're interested in it. But the answer to this one is B. 3, all the following are set by the board of directors except. It's the X date. This is very much a test question. B as in boy. What are some other questions? I've got them here all in a row for you, but the X date. When is the X date? 1 business day prior to record. What is the X date? It's a function of the Uniform Practice Code. It's the first date on which the stock no longer trades with the dividend attached. And so the answer here is B. And the stock should go down by the amount of the dividend on the X date. And so one of our big no-nos is to use that as an artificial sense of urgency. And we shouldn't be using the X date as the artificial sense of urgency. That's a big no-no, and that's called selling dividends. A great mnemonic, I have a whole lecture for you, about 35 minutes on mnemonics, but a good one here is DERP, D-E-R-P. A good way to remember the proper chronological sequence for dividends is the declared date, the X date, the record date, the payable date. So test taking trick here, I could shop this answer set and say, okay, so I need the declared date first. That's Roman numeral 3. And so the only one that starts with Roman numeral 3 is choice D as in dog. So test taking tricks, I suggest learning the information, but when all else fails, test taking tricks aren't bad. Who takes the seller's name off the shareholder list to put the buyer's name on? That would be the registrar. Test question. The Uniform Practice Code standardizes trading within the securities industry. You can imagine what a mess the securities industry would be if everybody was conducting business differently. And so we all agree we're going to do business the same way. And so if I would have said under the Uniform Practice Code, when does somebody agree to terms? That would be the trade date. Settlement is when ownership changes hands. That's C. That is C. Now be careful. Those settlement dates are different for different securities. For corporates and munis, the settlement date is T+2. And for options and govies, it's T+1. I had a guy the other day on debrief. He didn't get anything on settlement, which was surprising me. I mean, I usually at least get one or two of those. So, who knows if, sometimes what you're prepared for, you don't remember seeing it because you were prepared for it, but oh well. What would A have been the right answer to? A would have been the answer for the date the bonds start to accrue interest for the next time frame. That would be the dated dates. That would be those semi-annual, whether it's J and J, or F and A, or M and S, whatever the case may be, A and O, M and N, J and D, J and J 15. The record date is when the issuer is going to look at their shareholder list and see if you are on the a shareholder as of record, and if you are, then you're entitled to that dividend. The record date, it makes sense that the X is 1 business day prior, because to be on the record shareholder list on the record date, you have to buy the day before the X. The answer to this question is C as in Charlie, the settlement date. There's no multiples on the test. There's no multiples on the test. But, I feel okay. I can use multiples to make up practice questions, because at the end of the day, it's not about, whether there's multiples on your exam or not. It's about the intellectual takeaway. And it is very important. When I say it's a guaranteed test question, what I just mean by that is I don't know of any draw in which you don't get the test question, that type of question. Some questions like, it's a test question. Who knows if it shows up on your particular draw? It doesn't mean verbatim it's going to be a test question. It means you can expect test content around this concept. And so one very important thing you need to be able to do on your exam is contrast rights and warrants. And rights are short-term and exercisable below the current market price. So in this example, 1 and 3. And warrants are exercisable above the current market price, and they're long-term. So you have to be able to contrast rights and warrants. I know of no draw of your exam in which you're not going to be asked about American Depository Receipt. Telefonos de Mexico is the monopoly phone carrier in Mexico. It is very easy for me to wire the Mexican bourse and buy the Mexican security in the Mexican market. That doesn't take me long to do that at all. Or I could buy Telefonos de Mexico's American Depository Receipt. That's just easier. What I'm buying is that in the foreign branch of a domestic bank, the Bank of New York, Mexican City branch, there's 1,000 shares of Telefonos de Mexico, of which I am the beneficial owner, So it can best be characterized as a foreign security, Telefonos de Mexico, traded in domestic market. Sometimes people take exception with the way I've written this question. Well, it's really a domestic security, Dean. Well, you get the idea here. It's a foreign security, Telefonos de Mexico, traded in our U.S. domestic market as an ADR. As I'm taping this lecture, this explication of this practice exam, they're talking about delisting the ADRs from Chinese companies in New York. Now, those American Depository Receipts for those Chinese companies, if they do delist them, would still be trading in their home market. So it's not such a big deal. But I heard the issuer has asked New York to please reconsider. So the answer to this one is B. The other test question about ADRs that you could expect is that I still have foreign currency risk. So if I buy Telefonos de Mexico as an ADR, and they're collecting the phone bills in pesos, which they are, and it used to take 10 pesos to get a buck, which it did, and now it takes 20 pesos to get a buck, which it does, my dividend got cut in half. And so the other very much to test issue is to understand that in ADR, you have foreign currency risk. I said I was going to use my annotation tool, but I think I will, because, in certain questions, it's important enough that we should probably, go ahead and put it on there. I have suggested that what you should do is draw a flat line which represents a bond at par. This is called the teeter-totter. I have an excellent lecture on secondary markets. I highly recommend it. No surprise the dean would recommend it, but kind of overkill. I mean, we go over a lot. You also will see this seesaw or teeter-totter in my little mnemonic memory aid lecture as well. So it says bond purchased at premium. So then we're going to do here is make our line there. And that represents the nominal yield, which doesn't change. And then we're going to have the current yield here, the yield to maturity here, and the yield to call would be the lowest yield. That's very testable to know that when you buy a bond at a premium, you should quote the lowest yield, the yield to call. Sometimes we call that yield to worst. Would definitely be a handle on that. So one of the risks you have is that when interest rates go down and bond prices go up and are trading at a premium, one of the risks you have is that the bond's going to be called. Very testable. The call protection consists of two things, time and price. How long before the issuer can call the bonds, and at what price can they call the bonds? So, boy, there were truth in labeling, by the way. They wouldn't call this the stockbroker's test. They would call this the bond broker's test. There's way more questions on bonds, than there is stock. I like this one. That nominal yield is the fulcrum on the teeter-totter. So the nominal yield is also known as the coupon rate because in the old days, bonds had coupons, and you'd clip the coupon, you take it to the paying agent to get your money. And so even though we don't have bonds anymore that have coupons, we still refer to that nominal yield as the coupon rate or the fixed or stated rate of return. And the issuer says, we don't care who's got the bonds, we're going to pay them the nominal yield. The one I use in the secondary market lecture and the one I use in the mnemonic lecture is Ford Motor Company 8% debentures. Ford recently issued $8 billion in 8% Ford Motor Company debentures. Ford says, we don't care whether you bought the bonds from us as a primary transaction, the issuer, or you bought in the secondary market, we're paying 8%. Corporates and munis test question are trading eighths. So the minimum spread I'm ever going to make as a bond desk is an eighth. And so what you have to be able to learn on the test is turn that into it. So to do this, the first thing you got to know is that a bond point is $10. So let me get out my text box here. That's 1% of par. And so that would be 3/8 of $10. You can take your calculator and put 3 divided by 8. That's one way to proceed. And 3/8 of $10 is $3.75. So you should be prepared to turn that into a dollar amount. A is an eighth. C is the answer here, and then D would be 5/8. So you should be able to prepared to do that. Again, we said that what you want to be able to do on these bonds at a premium, I can't imagine any draw in which you're not going to get a bond trading at a premium. And so what we said we should do is draw a flat line, which represents a bond at par. There's our bond at par. And then we should draw a line that represents a bond at a premium. There's our nominal yield. Here's our current yield. Here's our yield to maturity. And here is our yield to call. And so with the teeter-totter, I love the teeter-totter because it turns aim and shoot or judgment questions into aim and shoot point and click questions. And so whenever I can do that, I'm a big fan. And so it says this is a bond at a premium. Again, this isn't a lecture. So, if you are lost on what Dean is doing as I'm explicating this exam, you need to go back and read your book or, do your practice questions or, watch Dean's lecture and come back to this. But you should definitely know, again, the bond at a premium, the yield to call, then it's going to be yield to maturity. The fancy word for yield to maturity, by the way, is basis. And then current yield and then nominal yield. So let's see. So we want yield to call. We need a 3. So it's either that one or that one. Then we need our yield to maturity. So I need a 3 and a 4. Boom. And again, there's no multiples on your actual exam, but the test concepts are there. And so I gave myself permission to use multiples in this practice final, even though that's not something you're going to see on your test. What you're going to see on your test is, do you know that when you buy a bond at a premium, it's because interest rates since the bond has issued have been gone down, causing the bond to go up? There's an inverse relationship, very testable. And it's unlikely that if you buy this in the secondary market at a premium, that you're going to get to hold it to maturity. It's very likely these bonds are going to be called. The Ford Motor Company debentures were callable in 5 years at par. And so if you buy them in a premium in the secondary market, it's very likely you're not going to be able to hold them to maturity. Which of the following requires a contract between the issuer and the trustee for the benefit of the bondholder? That is the Trust Indenture Act of 1939. The Trust Indenture Act of 1939. D as in dog. If I said which of the following requires a prospectus when selling brand new securities to the public, you would say 33. If I said, what created the SEC, that was 34. 33 and 34 were companion pieces of legislation. So Congress knew in December 33, they're going to come back in 34 and pass that. And the Mutual Funds Investment Company Act of 1940, all that legislation, 33 and 34 was in the New Deal, President Roosevelt. And he said, you guys in the securities industry will thank me later. Now on your exam, sometimes you can get these right by covering up the screen and asking, are they asking me about paper, prospectuses? 33. Are they asking me about people and places? That would be 34. Two major risks in a bond, the two major risks in a bond are interest rate risk and credit risk. Interest rate risk and credit risk. And so the lower the credit quality of the bond, the more likely the bond is going to default. This is very much a test issue. And so below triple B, D as in dog, below triple B, bonds are less than investment grade. In the real world, sometimes we call that junk, but one man's junk is another man's treasure. So in the test, we just say less than investment grade. As I told you, call risk, very testable, is associated with falling interest rate environment. So, one of the risks you have is when interest rates go down, it's much more likely if you have bonds in your portfolio, they're going to get called away from you. Listen, if anybody ever asks you about economics, finance, investments, and you want to sound smart, say it has a lot to do with interest rates. And if you just shut up, you sound good. People say, what about them? You say, well, they fluctuate. They go up, they go down, Oh, well, so interest rates go up, bond prices go down. Interest rates go down, the bonds go up, and then they're more likely to be called in the secondary market. The stock market is all about expectations of earnings, future expectations of earnings. And so stock prices are considered to be a leading economic indicator. By the way, they've removed a lot of the economics from the Series 7 into the SIE. And so I would expect that most of these economic questions would now be found in your, SIE and not in your Series 7, but oh well. And so more of an SIE question, but, still I got it here in the exam is a negative yield curve. That's when short-term rates are higher than long-term rates. And that too is a leading economic indicator. That one's a negative one. So the answer to this one is 1 and 3. As I mentioned, we don't have multiples. I wouldn't worry too much about that one on your Series 7. I'd worry more about that economic discussion on your SIE. Boy, very important, very important. When you get a convertible question, it's very, very important that you stop and you say, I don't need the conversion price. So when given the conversion price, you need to establish the conversion ratio. You can't do any calculation of parity without establishing the conversion ratio. Now, the way we're going to do that is we're going to take par, because that's what that's based on. And we're going to divide by par 1,000. We're going to divide by the conversion price of $40. And once I do that, I'm back in business because now I have the conversion ratio. And so then the way I'm going to get parity is I'm going to take the current market price of the convertible, current market price of the convertible. I'll put CMP, that means current market price of the convertible. And I'm going to divide by the conversion ratio, and I will get parity. I would expect you're going to have to do a parity calculation. So let me get my calculator. And now I'm back in business. I say, okay, the bond is 130% of par. That's $1,300. I'm going to divide by 25 shares, and that's 52. The answer is C, 52. Now, the stock should be trading somewhere below that. I mean, if the stock is trading above that, you would have an arbitrage opportunity. Arbitrage is profiting from price discrepancy. So, if I buy this bond and turn it into the stock, I'm going to be paying $52 for the stock. And so, here let's make sure I put that down there for you. I highly recommend when you're watching any videos of mine that you have a pen and paper, or you have your snippet where you can snip the screen or whatever you need to do. So there's that math. By the way, you got to be able to perform the 3 styles of questions you get on your exam are recognition, things you just either know, like settlement, when do options expire, that kind of thing. And then you get practical application. This is practical application. You can't give up practical application math questions because there's no interpretation about what parity is here. It's 52. And you want to save your misses for judgment questions. Judgment questions are those questions where you go, I don't know, do I put this thing in there? Do I take this thing out of there? That's where you want to give up your misses on those judgment questions. A lot of people struggle with suitability, and a lot of times it's because suitability are typically judgment questions where you got to kind of, reason your way through it. Let me clean up my screen here. I don't know of any draw in which you don't get asked about bankers' acceptances. I mean, they just love asking you about bankers' acceptances. Bankers' acceptances are used to facilitate foreign trade. That's very much a test question, D. I would definitely know that bankers' acceptances are issued at a discount, and they have a 270-day max maturity. So the answer here is D as in dog. If I would have asked you which of the following is the risk-free rate of return, you would have said T-bills. Repos is what I use as collateral overnight to get money. If I'm a bank and I go to the central bank, the Federal Reserve, I say, here are my Treasury bonds, can I borrow money? That's called a repo. And then we talked about what American Depository receipts are. That's Nestle, a Swiss company trading in the US, or Telefonos de Mexico, or Toyota, or Samsung, whatever the case may be. All of these interest rates are very testable. So all of these could have been a right answer. All of these could have been the right answer. The right answer here is A. Fed funds is banks with excess reserves lending to banks with deficient reserves. And so that's A, and it's targeted by the Fed. The Fed doesn't set it. It's targeted by the Fed. And it's the most volatile. If I would have said which of the following interest rates is set directly by the Fed, you would say discount rate. If I would have said, what do large commercial banks charge their best customers, you would have said C, the prime rate. And if I would have said which of the following interest rate is used to calculate or used in interest charges on debit balances in a margin account, that'd be broker call. That's what banks charge brokerage firms, and whatever we're going to charge you, or whatever they're going to charge the broker dealer, we're going to charge you a little extra. But the answer to that one is the Fed funds. If you're going to make flashcards, making flashcards is not a bad thing to do while you're watching the video, and that's certainly a good test fodder for flashcards. I think flashcards are underrated as a study tool. They also are great to get rid of significant others who are bothering you while you're studying. You can say, hey, honey, can you run the flashcards with me? Probably wouldn't make it long before they say, oh, I'm out of here. Again, definitional question, that's a GO. Full faith and credit of the issuer is a general obligation bond. Industrial development bonds are known as private activity bonds. A moral obligation is a type of revenue bond, and a special assessment bond against the benefit of property. The answer here is D. I haven't put up a muni lecture yet. I probably will. I'm just in my mind trying to decide how to carve it up, because I'm thinking about putting munis in 2 places, how we underwrite them in the underwriting discussion, and then, munis themselves. But, make sure you understand that you're going to get lots of muni questions, lots of mutual fund questions, and you're going to get lots of option questions. Again, general obligation bonds do require voter approval. So D. Revenue bonds do not require voter approval because the voters aren't on the hook, right? I mean, I can't wait till the pandemic is over and I can go see my friends in San Francisco. I spent most of my career there, and they have a sign that I love at San Francisco Airport. It says, your taxpayer dollars not at work. And I'm trying to tell you, you're not paying for the airport, the users are. And so the revenue bonds would default if the user fees are insufficient. The answer 21 is D. D. And the event of the default, there we go, there's the moral obligation bond. In the event of default, which of the following may require a vote of the state legislature to appropriate funds from the state's general budget to pay interest and principal on the defaulted bonds? Those are called moral obligation bonds. They used to show up on the exam a little more. I haven't anybody tell me they've seen them in a long time, but they used to show up pretty good. Hey, I just got some debrief from a guy. He said he saw this one. So we always assume on the test a net revenue pledge. This is found in what we call the trust indenture. The trust indenture is a promise between the issuer, in this case, a municipality, not the trust indenture Act 39, because they're exempt from that. This is called the trust indenture, wherever we have it. But if you're lending money to a political organization, you're certainly going to require this. Anyways, the fund that has priority is operations and maintenance, A. That shows up a lot, and I just did a debrief recently, and the guy said he actually got that on his exam. So gross revenue, debt service would be first, but that would be penny wise and pound foolish to do that. So the answer 23 is A. Corporate credit. Chicago has an industrial development agency charged with luring employers into Chicago. And I think Mr. Boeing would be rolling in his grave if he knew they moved the corporate headquarters of Boeing out of Seattle. And before they moved the corporate headquarters, they said, attention, Dallas, Denver, Chicago. We're thinking of relocating. What are you going to do for Boeing? And the city of Chicago's industrial development agency said to Boeing, if you will move to Chicago, we will go ahead and build that corporate campus turnkey to your specifications, ready to occupy. Woo. And so they said, how are you going to do that? They issued some industrial development revenue bonds. And test question, corporate credit backs the bonds. Boeing's corporate credit is single A. Chicago is double B. So what goes on there? Single A or double B? Single A. Corporate credit backs the bonds. That's very much a test question. The answer to this is A is an atom. The other thing I would know about these industrial development revenue bonds, also known as private activity bonds, is they may be taxable to an investor subject to the alternative minimum tax. And so there's going to be a kind of a binary suitability question here. Are you subject to the AMT? Yes or no? Because if the answer is yes, we shouldn't do this. Well, there we go. There's the next question, right? So there's that next one. These questions, by the way, have come from, I call them questions from the front. So what I do is save up questions. I'm not allowed to ask you particular questions you've seen on your exam, and you're not allowed to give them to me, but I'm allowed to say, what weren't you prepared for? What could we have done a better job preparing you for? I save the notes I take based on debrief. And then, when I have some time, I sit down and turn them into practice questions like these that we're looking at. So, I'm not making these up out of thin air, is I guess what I'm telling you. These won't be exact carbon copies of what you'll see on the test. It's more, again, not about the particular question. It's about the intellectual content of the question, the intellectual takeaway. They love the accept format. At some point, I would highly recommend that you get out a sheet of paper and fold it in half. And on one side, write all the terms associated with GO bonds. And on the other side, all the terms associated with revenue bonds, because they just love this kind of stuff. They just love it. So a feasibility study goes with a revenue bond. Competitive facilities go with a revenue bond. Debt service coverage ratio. I'm not going to make you crunch it on the exam, but you need to know it goes with a revenue bond. And no. Ad valorem taxes. The answer here is D as in dog. Ad valorem taxes, property taxes support GO bonds. This is also known as overlapping debt. So I'm coming to you from, my studio in fabulous Las Vegas. And Las Vegas is in Clark County. So Las Vegas is 100% coterminus with Clark County. You cannot be in Las Vegas without being in Clark County, Nevada. Now, listen, Clark County isn't 100% coterminus with Las Vegas. You could be in Henderson. You could be in Summerlin. You could be somewhere else. Now, what we mean by that is if I ask my real estate agent how coterminus is the home I'm considering purchasing, I'm asking how many people can send me a tax bill that I must honor. Co means together in Latin. Terminus means living together when two or more taxing agencies. For example, the school district would be coterminus with the city. The city would be coterminus with the county. Now, that's another one that I haven't had anybody tell me they've seen in a long, long time, but it used to be a good test. I just had a recent debrief where the guy got a question about a bond counsel. He got asked about who, is the one who does it. And it's the issuer. But, the bond counsel is going to provide a legal opinion. And what he's going to opine about is they have the legislative, the municipality, authority to borrow the money, that the interest is federally tax exempt, and the muni bonds are exempt from 33. And D, no, credit quality or rating, that's not the bond counsel. That would be Standard & Poor's. That would be Moody's. Daily bond buyer, another one that used to show up. Nobody's told me I've seen it in a long time, but it's D as in dog. And 30 is one that's used to show up quite a bit and kind of has not been showing up lately, but it'd be the one who provides the issuer at the lowest net interest cost. This is definitely testable. We don't have prospectuses because muni bonds are exempt, but the prospectus-like document, very much a test question or test fodder, is the official statement. The notice of sales, what the issuer puts in the daily bond buyer, if it's going to be a competitive underwriting. The MSRB has no enforcement power. So the Municipal Securities Rulemaking Board is just allowed to publish rules. We deny them the enjoyment of enforcement. So all they can do is publish rules. And so that means they have no enforcement powers. Who's going to enforce their rules? Well, the same person's always enforced rules on a bank. The FDIC, the Federal Reserve Board, and the Office of Comptroller of Currency. Please note, if all a bank wanted to do is munis, they wouldn't have to join FINRA. Now, most banks do want to do other things, and so they set up broker-dealer subsidiaries. But if I'm a bank and I want to do munis, I don't need to set up a broker-dealer. Again, we're just explicating this, in these lectures that I always tell you, if you want me to go deeper, I certainly can. I'm avoiding going into a much larger, deeper conversation. But, in the comment box, you say, hey, I want it. I'm more than happy to give you the historical background. I love this answer set. Again, the idea here in this explication of this practice exam is not so much the questions and the right answers, but these answer sets are what we're really trying to get comfortable with. And we talked about the Uniform Practice Code. The answer to this is C as in Charlie. C as in Charlie. But these all could have been answers. If I would have said, which of the following handles trade practice complaints, that would have been A. And a good way to remember it is the COP. So, if maybe I'm a market maker and you say, Dean, are you backing away from your quote? I say, I am. What are you going to do about it? It doesn't scare me if you don't know what to do. You say, well, Dean, under the code of procedure, I say, never mind, you're filled. You're filled. The code of conduct could have been the answer. The answer is C as in Charlie, but if they would have said on your exam, which of the following establishes the ethical behavior that broker dealers and associated persons owe customers, that answer would have been B as in boy, the code of conduct. If I would have said on your exam, which of the following is used to settle civil disputes, that would have been the code of arbitration, Nominal quotes. If I call the bond desk, I say, listen, I'm getting ready to updo my financial statement before I'm in my bank, and I need to get some quotes on my munis. And the bond desk said, Dean, let us give you some nominal quotes. And they give me a quote. I go, wow, sell it. They go, whoa. Dean, I told you it was nominal. If you'd like me to give a firm quote, I would do that. So a quote for informational purposes only is called a nominal quote. That's what's on your statement, by the way. We tell you on your statement, all those quotes you're looking at are nominal quotes. They're for informational purposes only. 35, this just shows up on almost every draw, SIE Series 7, types of orders. This is an opening sale. B, I can't imagine that you're not going to get that answer set. And, at almost every lecture, I go over this. If I have any excuse to do so, I go over it because it's there. If I would have said which of the following is used to eliminate, offset, or reduce a short position, that would be a closing purchase. Money out versus money in. Well, there you go. There's the other version of that, right? So the answer to 35 is C as in Charlie, very much a test issue. The answer to 36 is C as in Charlie, very much a test issue. Now, be careful on 37. I'm not asking what can happen to a player. I'm asking what can happen to an option contract. When I set up the, the Series 7 subreddit, I for some reason I got booted from the other two. I would much rather participate in the other two subreddits, but for whatever reason, no explanation, the anonymous moderator or moderators booted me. And so that means I had to come up with 50 karma points and be on the site for 30 days to be able to start my own subreddit. Anyways, long story short, it was easy because I just went to the subreddit for options and needs an option guru. It took me about all 2 minutes to start answering option questions for people and helping them out. And this is something, by the way, I don't know how these people in Robin get approved for options because, boy, I got to tell you, there are a lot of confused people over there. Anyways, I think a lot of them are confused about what happens to them and what happens to the contract. So if we're looking at an Apple, what is this? This is January. Let's say we're looking at an Apple April 130 call. I'm not asking what can happen to a buyer or seller. I'm saying what can happen to an Apple April 130 call. It can be traded, it can be exercised, or it can expire. Now on your exam, every question is going to end with either the contract got traded, the contract got exercised, or the contract expired. Again, I would review you or have you circle back to the options lecture. At some point, I'm under no obligation to tell you what happened to the option contract. And what I mean by that is, you're supposed to know that if at expiration, the contract has intrinsic value, it's going to be exercised. And if at expiration has no intrinsic value, it's going to expire. Now, break even doesn't happen to the April 130 call. That's what happens to a player. The most common description, the most complete description. So, if you're going to trade options, I ask you, what type of contract are you interested in? You say, well, how many types are there? You're kind of confused. I mean, because there's two types. There's calls and puts. And that's an incomplete description. You say, Dean, I'm interested in call contracts. I say, what class are you interested in? That would be the type plus the stock. That would be Apple calls. And the Apple calls, there's lots of those. Are you interested in the Aprils, the Mays? You say, Dean, I'm interested in the Apple April calls. That's still an incomplete description. Because in the April category, there's 125s, there's 130s. The most complete description of the option contract is a series. So the answer here is C. And again, I would refer you back to lecture 1 in options if you were struggling with that. All right, so here we go with some option questions. Again, the option questions I have here for you are less random because I want you to kind of figure out where in the options discussion you might be struggling. And so, what I have highly recommended to people when they're doing options, and I'll just follow my convention here. And then see, I've always recommended that what you might want to consider doing I'll get myself a smaller font here, is you might want to, underneath this, say, what am I looking at? And what you're looking at is a choice to buy the stock at the strike price. So that's what that is. And the break even in call contracts is strike price plus premium. Strike price plus premium. So the answer here is 104. 104B. What is the maximum gain? Well, when you're long a call, your maximum gain is unlimited. So the answer number 40 is B, unlimited. Unlimited. What is your maximum loss? Well, one of the great things about buying options is if you're wrong, you're just going to lose your premium. So this should be $400 you can afford to lose because it's very likely you're going to do so. If the stock is 100 or lower, the contract is going to expire and you're going to lose the premium. So 41 is the premium. Every contract has two parties. And so here, this is an obligation to sell the stock. That's what a short call is. Same break even, 104. If I have to buy the stock at 104 and deliver at 100, I lose 4 points. I got 4 points. The break even is 104. A good mnemonic for break evens and calls is call up. Call up. Now, this is very foolish, because if I do this and I'm right, I get to keep $400. My maximum gain is the premium. Guaranteed test question. When you agree to sell stock you don't own, your maximum loss is unlimited. This is called a naked or uncovered call. Now, I highly recommend that you might want to consider circling back and looking at the options lecture on multiple option strategies. So what Dean has done here is pretty cool. Let me show you what I've done here. What I've done here is I said, well, okay, I don't want to be stupid. So what I did was offset my obligation to sell the stock with a choice to buy the stock. That's just really much smarter. So options are all about floors and ceilings. And so what I've done here is a spread. A spread is when I'm long and short the same type of contract. When I'm long and short the same type of contract. And so this is pretty smart because remember, this is the leg here that we were looking at was that short 1 BFD December 100 call at 4. And when we just did that, we could make 400 and we could lose everything. So we took part of our 4 points and we bought a higher strike call just in case. So I'm saying I want to play between 100 and 110, and then I don't want to play no more. So one thing you got to be able to do is tell me that what you're looking at is a spread. A spread is when you're long and short the same type of contract. You're long and short the same type of contract. So the break even. Before I created this spread, here was my strike price of 100. And here was the market price. And, I had brought in 4 points. And then my break even was 104. My break even was 104. And then past that, I started to lose money. So what I said is, I think what I'll do is take some of my money and go get myself a 110 call. So, here I have a floor, and now I also have a ceiling. I'm saying I want to play between 100 and 110, and then I don't want to play no more. So my break even now is not going to be 104 because I spent some of my money. And now I only have a 3-point cushion. Now, a good way to remember how to get break evens and spreads is CAL. And that stands for call, add to the lower. And so what I'm going to do to get the break even here is I'm going to take my lower strike and add my net premium. And I get my break even of 103. Now, listen, I'm just explicating a practice exam. I'm not lecturing on options. But in the multiple option strategy lecture, what you've got to be able to do on a spread is determine that it's a spread. You have to be able to identify it. And then you have to determine whether it's a debit or credit spread. This is, in terms of money out and money in, that's how I like to proceed. But in terms of money out, I got 4 points in, and I've got 1 point out. And so this is a 3-point credit spread. Then I got to determine, do I want the contracts to expire or exercise? Do I want the difference in the premiums? Right now, the difference in the premiums is 3. Do I want them to widen or narrow? And what is the max gain, max loss? The max gain, max loss, by the way, always equals the difference in the strikes, because that's the whole point of a spread. So whatever those two numbers are, they got to add up to 10. I'll just illustrate that indeed the break even is 103. You always want to know when you're doing spreads, you always want to know what is the dominant leg. And the dominant leg is always the leg with the greatest premium. So the dominant leg is that short call. If I'm trying to figure out what's going on, the larger premium dominates the position. And so the dominant position is my obligation to sell the BFD at $100 a share. And so if I buy the BFD at 103 and I deliver it at 100, I'm just illustrating that indeed that our break even is 103. Now, what is my maximum gain? The maximum gain, whenever you sell an option contract, is that contracts expire, contracts expire, and you get to keep the money. So the best case here is these contracts expire, and I'm going to keep the $300. By the way, before I turn this into a spread, I can make $400. So now the most I can make is 3. Remember that I'm playing between here and here. So what are the gain and the losses? They always equals the difference in the strikes. So whenever I collect money, the best case is I get to keep it. So whether you're short a call or you're short a put or you're short a straddle or you're short a spread, anytime you collect money, the best case is both these contracts expire and you get to go neener, and you get to keep the money. That's as best as it gets. Now, again, this is just an exploitation. So if it sounds like Dean is speaking some foreign language, I would highly recommend, you go back and review this lecture. Now, the maximum loss, we said the gain and the loss always equals the difference in the strikes. It always equals the difference in the strikes. So, there's my strike of 100. There's my strike of 110. There's 10 points to be made or lost. I collected 3. So the worst case is I'm going to lose 7. If I buy the stock at 110, which I have a choice to do, and I deliver at 100, I'm going to lose 10 points. But remember, I already have in my account 3. So the most I'm going to lose. By the way, that's a heck of a lot better than a naked call. A heck of a lot better than a naked call, right? Because if I'd done the naked call, I would have all kinds of risk. And so a credit call spread is much, much smarter than a naked or uncovered call. So again, by the way, the vast majority of your option questions are going to be the basics in a covered call. So I wouldn't get too stressed if, you're in over your head here a little bit, but I would tell you to go review the multiple option strategies lecture, where we go through how to run that entire menu and how to come up with these answers. And this was done for a net credit, right? All right, so let's look at our next one here. So again, what I did here is I took a basic option strategy. So let's just go back here. I'm just reviewing where we started with. So I took this basic option strategy here. And what I didn't like about that basic option strategy is that I could make 4 and I could lose everything. That was a naked or uncovered call. And so what I did is I took part of my money, and I bought a higher strike call just in case, right? So I offset my obligation to sell that stock at 100 with a choice to buy at 110, kind of bueno now, because there's only 10 points of market action. There's a floor at 100 and there's a ceiling at 110. That's just a heck of a lot smarter. Test taking trick. The break even in a spread always has to be somewhere between the two strikes. So, you can eliminate 114 because that's not between those two numbers. It's got to be somewhere between there. You can eliminate 97. It's got to be somewhere within the range. So it's either B or C. We said it's B. We use call, add to the lower. We said in a credit spread, the most you can make when you collect money is the premium. We said the max loss was 7. Now here again is a basic option position. This was a credit spread. Here I'm buying a put for 4. And again, what that is a choice to sell the stock at 100. That's a choice to sell the stock at 100. If you only remember one thing about options, you should remember call up and put down. Call up and put down. The break even here is 96. 96. And so what I'm hoping is that the stock will go all the way from 96 to 0, right? Again, some people like to use minus signs. Some people like to use debit. I like to use dollars out. Some people like to use pluses. They like to use credit. Dean likes to use dollars in. But here I paid 4 points to be able to stick the stock to somebody at 100. And so the best case is I get that out of the trash can and I make somebody give me $100 forward with stock. So my break even is 96. And the most I can make is break even to 0. I need the stock to go all the way. Here's my strike price of 100. I want it to go all the way to 0. Now, once I cover my out-of-pocket cost, then I start to make money. So that's what I'm hoping to have happen. Boy, buying a put is a lot smarter than shorting the stock. As a bear, another thing you could do besides buying a put is you could actually, short the stock. And one reason people buy options, where they buy calls or they buy puts, is because if you're wrong, you're just going to lose your premium. And so that's one reason people buy options. You have less risk than you have in the stock position. So maximum loss is the premium, in this case, $400. Well, if we're going to have put-ers, we got to have put-es. If we're going to have put-ers, we got to have put-es. And I'm hoping that at some point you're pretty quick at looking at this and saying this is an obligation to buy the stock at 100. That is an obligation to buy the stock at 100. The break even is 96. If somebody makes me pay 100 and I sell the stock at 96, I lose 4 points. I got 4 points. I break even. If you only remember one thing about options, please remember call up, put down. call up, put down. So the break even here is 96. The maximum gain, I agree to be a potential victim. Nobody victimizes me and I get to keep the money. I had a client named Mark. This was my idea. Test question solicited. I called Mark and I said, hey, listen, there's this buyout, all cash financing in place at 75. And Mark, we can sell the 75 puts for 13. 10 of them, that's 13 grand. And if Dean is right and the stock closes at expiration, 75 or higher, we're going to get to keep the 13 points, the 13 grand. That's exactly what happened. That's exactly what happened. He got to keep the 13 grand. Now, after that, he loves it. He calls me, he goes, Dean, his idea, test question, unsolicited. He said, Dean, we can sell these 240 puts. We can obligate ourselves to buy the stock at 240. He said, right now the stock is 260 and there's a rumor buy it at 280. And if I sell 10 of these contracts, I can get 20 points. That's 20 grand. I said, well, Mark, call me a cynic. But if somebody's willing to give us 20 points for a 240 put when the stock's that far out of the money, maybe they know something we don't know. I mean, call me a cynic. I said, but Mark, that's very, very foolish because if this thing falls out of bed, you're going to have an obligation to buy 1,000 shares at 240. That's 240 grand. Now I'm looking at your account and you do have cash equal to the aggregate exercise price. So at least we, don't have any worries there. I said, Mark, would you please do me a favor? Would you buy a lower strike put just in case it blows up and somebody sticks it to you? Why don't we have a lower strike put and then we can stick it to the next guy? Why instead of selling this put, why don't you do a credit put spread? That's just a lot smarter to do that. Right. So, as a supervisor, I just love spreads because it's about that floor and the ceiling. Right now, there is no floor here. And the worst case is the stock goes to zero and somebody's going to stick it to me at 100. I'm going to pay $100 for worthless stock. And so my maximum loss is going to be break even to zero. So maximum gain is the premium. Maximum loss is break even to zero. Now, again, that'd be another reason to maybe a credit put spread. That might be a thing I might want to consider doing. Anyways, he didn't do it. The stock at expiration was 120. Uh-oh. I called him at his cabinet. He said, Dean, I thought I told you never call me at my cabinet. I said, well, Mark, I thought this would be an exception. He said, well, it's not a loss until I sell the stock. And he goes, I'm not really down, 120 grand because I got 20 up front. I'm down 100. And I go, well, okay, man, I tell you, big boy, I mean, I wish I could take it in stride like that, but oh, well. It looks like Dean didn't break the page here. It looks like I should have had a better page break than I have because now we're going long a call. We're going long a call. And we're going long a put. And so again, what we want to do is get our T fired up. Dollars out versus dollars in. Now, again, if you're following Dean's method, I mean, there's a lot of different methods to do options. And, if you were with me on my options lecture, I like to use what's called the options matrix. The options matrix is, this would be the long call quadrant. That's the long put call quadrant. And what I like to do is total up these premiums. And so here I'm long a call and I'm long a put. And test question number 1 is, can you identify this as a straddle? Can you identify this as a straddle? Straddles are pretty straightforward on the test. Can you identify a straddle? And so this is a straddle when we're long 2 different type of contracts or we're short 2 different type of contracts. What I'm straddling, by the way, what I'm straddling is the strike price line. So that's what I'm straddling. So let me get my T fired up again here. Here's my strike price. Here is the market price. Here is my T, dollars out versus dollars in. And so what I'm going to do to get my break evens is I'm going to total the premiums and I'm going to add it. Now, if this was just call, I just need 4 points here. To the call, I'm going to get my upside break even of 108. Nobody does things to break even. And I'm going to subtract it from the put to get my downside break even. So test question number 1 is, can you identify a straddle? Long 2 different type of contracts or short 2 different type of contracts. By the way, a combination is just a straddle with different strike prices. You wouldn't do anything different. So test question number 2 is, can you calculate break evens? test question number 3 is, where is the straddle profitable? And if you're long a straddle, you want the stock either above or below the break even. And we have 2 versions of these. We have long straddles and short straddles. And then when do you use it? You use it when you expect volatility, but direction is uncertain. Direction is uncertain. So break even is 108 and 92, and it was a straddle. Okay, so we're just going through all these options positions, all these option positions in our explication of our practice exam. And so here's our next one. And again, what Dean likes to do, doesn't matter what Dean likes to do, it's can you come up with the right answers? You know, what I like to do, I told you, is I like to make a T and track monies in and out of the account. So, boom, boom. And then I like to look at what I got going on here. And so I bought the stock for 92, and then I obliged myself to sell it. Key point, I'm agreeing to sell. That's an obligation to sell the stock at 100, and I got 4 points for that. And so that's how I like to do what I call my setup. And so, by the way, on your exam, whenever you see 100 shares, you got to go, ooh, this is not an option position. This is a stock position. And this is called a covered call. A covered call was I'm agreeing to sell stock that I actually own. Be careful. This is the one time and the one time only. It's not call up. You know, in a covered call, it's the stock cost less the premium. Now, I would suggest if you get good at the T, you can just try these numbers and you plug them in until you get one that would make the columns balance, because that's what break even is. Break even is same dollars in as dollars out. And so if I plug 104 in here, that doesn't make the columns balance. That can't be it. If I plug in 96, that doesn't make the columns balance. If I plug in 88, ding, 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 ding. That's what break even is. Same dollars out as dollars in. So that's the break even. Nobody has things to break even, but you know, it's like a push when you make a bet, right? You neither made nor lost money. Neither made nor lost money. By the way, that's the one time and the one time only. That's the one time and the one time only where you're actually doing a call and you're not adding. And the reason you're not adding is because this is not an option position. Now, the disadvantage of a covered call is you said you would give up the stock at the strike price. You said you would give up the stock at the strike price. And so what is the maximum gain? The maximum gain is when you sell that stock at 100. So the most you're going to make is 6 points. Now here, be careful, because another way to think about it is I'm out 92 for the stock. I brought in 4 points for the option, so I'm out a net of 88. That was my break even. And I got to sell the stock at the strike price, which was 100. All right, so let me just I'm just getting myself some more room here to. All right, so here we go. Right, we paid 92 for the stock. We brought in 4 points for the option, so our break even was 88. That was our break even, and we got to give up the stock at the strike, which was break even to strike, which was 100. And so that's our max gain. Now, by the way, I wouldn't worry about that on the test, except to know that you don't participate past the strike price. So that's the downside of a covered call, is you don't participate past the strike price. So your gain is capped, is the way we say that. I have a good example of that from in your practice exam. Again, so you got to be real careful on the test when you get stock positions. So this isn't an option position again. This is a stock position. And so the big thing I would do again is get my T fired up so I can track money in and out. So when you see 100 shares there, you gotta say, whoa, this is not a stock position. This is an option position. And so I paid 92 for the stock. And then I paid another 1.5 for the protection. So this is the one time and the one time only that we actually are adding to get the break even. The break even is the stock. Oh, excuse me. I don't know. My annotation tool is breaking up. But this is the one time and the one time only that I'm actually adding and a put to get the break even. The reason I'm adding to get the break even is because this is not an option position. This is a stock position. By the way, if you get good at the T, you say, okay, well, I paid 92 for the stock, and I paid for the premium 1.5. And so my break even is 93.5. You could just plug in these numbers, by the way, until you get one that makes the columns balanced, because that's what break even is. Same dollars out as dollars in. Again, I would refer you to the options lecture. So we're explicating this, and you're finding yourself a little behind in terms of understanding what Dean is doing. The idea is not, can you watch Dean do tricks on a whiteboard? It's, do you understand what's going on? And this is why the reason you do this is because now your maximum loss is not zero. Remember, if all you did was buy 100 shares at 92, if that's all you did was buy 100 shares at 92, your risk would be all the way to zero, but you paid 1.5 for the protection. And so your break even was 93.5. And you can sell the stock anytime you want at the strike price. And so the maximum gain is the break even to the strike. The reason you do this is to have the ability to participate in a big price increase, but not participate in a big price decline. And so that's why you do this. I like this, the optional equivalent to a sell stop, right? So one of the reasons you use a sell stop is to stop a loss. And another way you can stop a loss is by buying a put on your stock position. That's another way you can do that. This one is just recognition. This one is just recognition on your exam. So you don't actually have to do any of the T's. You just got to recognize it. And so, if I short 100 shares of BFD at 92 and that's all I do, Daniel Drew, legendary Wall Street speculator, said those that sell what isn't his'n must eventually buy it back or go to prison. And so, that's not smart. So, if all I do, let me get my T fired up. If all I do is sell short this stock at 92, I'm going to have unlimited risk. But if I had a choice to buy back the borrowed stock at any time between now and set date, I would no longer have unlimited risk. And that's a neat arrow to have in your quiver. So I recognize that a long call changes that short stock position. So a buy stop, remember, a buy stop is to stop a loss in a short position. Another way you can do that is what I just showed you, that long call. Numbered accounts used to show up. I haven't anybody told me I've seen this in a long time. However, that being said, what happens a lot of times, I do a coaching call. It's the last coaching call they get before their whole cohort goes and takes their Series 7. And so it's kind of free form, whatever anybody wants to talk about. That's kind of what we want to talk about. And I had a young lady and she asked me about numbered accounts. I said, well, that used to show up quite a bit But I haven't had anybody tell me they've seen it in a long time. And then she called me after exam, said she shot again. So that happens. Some of these questions are in the Q bank and they drift in and out of that. But a numbered account operationally is the same as any other account, but we got to know who's on there. So we're going to have a letter attesting to ownership. If I'm a celebrity, perhaps I don't want my business all over town. So I might say, listen, I want a numbered account. The registered rep and the branch manager is the only one who needs to know that has that. And then test taking trick, by the way, this is called the principle of mutual exclusion. The principle of mutual exclusion means it's got to be C or D because those say opposite things. It can't be both C and D in the same universe. I call this the principle of mutual exclusion. This is like Socrates is a dog. Socrates is a philosopher. He's either a dog or philosopher. No, you don't have any special privileges. So, I had a customer once. He said, can I be 007? I go, sure, you're 007. I gave him a number to count 007. What the heck? What do I care? Anyways, he'd call me and say, I'd be 007. Anyways, I say, hey, 007, you got a maintenance call. He's, oh, I said, listen, no special privileges here. Love mom, but mom had a duplicate black card on my account and she didn't pay him. And I was asking mom, I said, what happened? She goes, well, you owed them so much and I owed them so little. I didn't think it really mattered. And, it's a black card. I go, oh, well, mom, operationally, that's no different than any other card. It works the same way. If you don't pay them, they're going to shut you down. This one is very testable. The 3 A's. It's very important you know what you need to accept an order, assuming you don't have discretion on the account. And the 3 A's are action, asset, and amount. Action, asset, and amount. So what you can decide without having asset and asset amount is time and price. I have a very good lecture on that where we have market not held orders. Time and price is called good execution, and that does not require trading authorization. The asset, whether to buy or sell, right? So whether to buy or sell, we call that action. So whether to buy or sell, action. The amount, and then the security, the asset. I can't imagine you're not going to get a couple of those on your exam. All right. All the following are unique to margin accounts except, trading authorization could be a cash account. The credit agreement, this is very testable. The credit agreement is where the customer understands that opening a margin account that he's borrowing money and he's paying interest based on broker call, very testable. The hypothecation agreement, that's where he understands that he's pledging his securities as collateral for this loan. That means the securities test question are going to be in street name, the name of the broker dealer. If he doesn't fulfill his responsibilities, we're going to sell him out. And then we ask him, can we lend your securities to our other customers who wish to go short? That's called the loan consent form. Now, by the way, the credit agreement is mandatory. The hypothecation agreement is mandatory. And test question, the loan consent form is optional. And so D is not unique to a margin account. A, B, and C most certainly are. Don't overdose on margin. I can't tell you how many people waste a lot of time on margin. 3-4 questions max. So, I'm more than happy. In class, I spend an hour and a half, 2 hours on margin. I say, listen, that's it. You shouldn't be doing any more. Now, some of your vendors have entire chapters on SMA, and if you're in doubt about whether it's important, not send me a thing. Say, hey, Dean, do I need to worry about this? I'm so proud of this guy. I wish they still gave scores because this guy deserves a high score. He worked hard for it. He was never at risk. And one thing I was so happy is he took my recommendation. Sometimes when people are working that hard, they don't listen to you. And I said, listen, my friend, you are overdosing on this. You need to let it go. There's so many other things that you could be spending time on. And, he followed my recommendation, which, a lot of people don't sometimes. So it's kind of exasperating. 69 is very testable. So we're going to file our S1. We're going to sell brand new securities to the public. And once we file the S1, that's why that's called registered securities. Custom securities that have not gone through this process are called unregistered securities. That's like, for example, I was reading where SpaceX has raised $6 billion in the private markets, Reg D. So all that stock is unregistered. It's restricted in terms of its transfer. At some point, maybe SpaceX files a S1 saying they're going to go public. And once we file that, we enter into the cooling off period. That's what we do to young lovers. We put one on the East Coast, one on the West Coast, tell them to cool off. They feel the same way about it, then go for it. That is test question, a minimum of 20 days. A minimum of 20 days. Very testable what we can do during the cooling off period. By the way, if we make it through this, that's called the effective date. We may or may not make it through that. The effective is when it now starts trading in the secondary market. By the way, you can't borrow money to purchase a new issue. It's considered a new issue 30 days from the effective date. That's very testable. And what I can do during this cooling off period while I'm conducting due diligence is I can send you a red herring, very testable, also known as a preliminary prospectus. I can accept indications of interest, which are non-binding on all parties, and I can place a tombstone. Very testable. As your investment banker, I say, listen, you're probably going to want to come back and get some more money. So I highly recommend when we make our original registration statement with the SEC, let's do a shelf. Let's put some registration securities on the shelf. Better to have them on the shelf, a registration statement for securities that are authorized, but we haven't issued, and not need it, then need it and not have it. And that shelf registration would be good for 2 years. That means we're telling the SEC that we might want to come back within 2 years and raise some additional monies. Now, there's another version of this that's 3 years, and that would be for WKSI. But on your exam, you would assume it's the regular 2-year version. WKSI is a well-known seasoned issuer of securities. So in municipal securities, it has a little bit of a different language. And so, maybe I'm the manager and I told the issuer that we're going to get them $9.90 for the bonds. And we're going to sell these bonds to the public at $1,000. That's what investors are going to pay. And so test question number 1 is, what do we call the difference between what the issuer receives and the public pays? We call that the spread. And so this example, the spread, don't tell me $10 because $10 means you're new. It's a bond, it's a point. So that $10 is a point. Now, as a member of my syndicate, let's say Gamma Global, I'm the lead. I said, I'll let you have bonds for $991.25. That's my management fee. So it doesn't matter who sells the bonds. On every bond sold, the manager is getting 1/8. Now there's two components to the spread that are left. Now the largest component of the spread is the selling concession. This I think is the trickiest part here. That 3/8 is called the additional takedown. And these two components together are called the total takedown. Please note the total takedown is not an individual component of the spread. It's actually two. So, spreads. And then if all you received here was the selling concession, if that's all you received, you're not a member of the syndicate and you're not at risk for unsold securities. You're not at risk for unsold securities. By the way, be careful on this one. Remember, that's not an individual component of the spread. That's two. That is this plus the additional takedown. So be careful what you're being asked. All right. Very testable exchanges. The answer is A, exchanges. Now, had I asked which of the following is a negotiated quote-driven market, then the answer would have been over the counter. So here the answer is A. Secondaries, direct trading without intermediaries. That's the institutional market, direct trading with institutions. That's called the fourth market. So the answer there is D. D is in dog, and they have their own electronic communication network known as Instinet. That stands for Institutional Network. These are participants on the New York Stock Exchange. And so the floor broker executes orders for clients of member firms. The $2 broker helps the floor broker with order overflow. The answer here is A is an atom. The specialist or designated market maker is the one who holds the limit orders. He's charged with maintaining a fair and orderly market. He can only trade at the price of better than what he's holding. He's supposed to make a continuous market. So all these could have been the right answer. The answer to this one is A. There we go. The answer to this one is C. The answer to this one is B. Types of orders. The only order that has no qualifier, no contingency, is a market order. You want immediate execution, best available price. So the answer is A. Your price or better, that's a limit order. The 79, the answer is B. A stop order can be used for all the following except. The answer here is D, right? Because, a stop order may never become a live market or limit order if it doesn't trade at or through the trigger price. So again, I have a very good lecture for you on that, so you might want to check it out. Technical analyst is interested in going long or short, depending if it breaks through its support or resistance. So he would place a buy stop above the resistance line. C is in Charlie. Again, I would refer you to the lecture. A technical analyst wants to go short if it breaks through the support line, so he places a sell stop, A. And then when it trades out or through, he goes short, A. Sell stops, accelerated bullish trend would be buy stops because as the market comes up, let me just take a minute here and give you a chart. On your exam, the charts won't look like they're supposed to look. You're not going to be struggling on your exam to figure out what you're looking at is what my point is. And so I'll just make a chart here of Apple. Here's a chart of Apple. And it looks like Apple's stuck between 120 and 140. We call this the support line. And we call this the resistance. And then it's time going this way. Price going that way. And then what he's going to do, he's going to say, okay, well, I'll put my buy stop right there. And if it goes down, and I'll put my sell stop. If it goes down, I'll put my buy sell stop there. So as the stock goes up, all these buy stops get triggered. That accelerates the bullish trend. And if it comes down, all these sell stops get triggered. That accelerates the bearish trend. Now it's not a buy stop limit because that buy stop limit may or may not ever be, get executed. So, the most appropriate answer would be that one. Very, very testable. We adjust orders that are below the market, and this mnemonic is worth a lot of points. So here's the current market price. And there's the current market price. Bliss. That's worth a lot of points. That stands for buy limits and sell stops or the orders are going to get adjusted for cash dividends, because you wouldn't want the stock to go down as a result of the X date and have your order be triggered. Now, if you don't want me to do that, you can say, Dean, please make my account or my order DNR. That doesn't sound for do not resuscitate. That stands for do not reduce, do not reduce. The inside quote, the inside market is the highest bid and the lowest ask, the highest bid and the lowest ask. There's no multiples, but I think it's okay for me to use them as practice questions, but it's Roman numeral 1 and Roman numeral 3. And then, the New York, it's coming from the limit orders the specialist is holding. Again, I would refer you to my lecture on secondary markets and types of orders. And so that would be 2 and 3, or 2 and 4. And in market making, NASDAQ or PINKS or bulletin board, it's the market maker's bid and their ask. Again, I would refer you to my secondary market lecture and my type of order lecture. It's about 3 hours. I think you'd be in pretty good shape after that. A market maker is going to have level 3. Level 1 shows you the inside quote. Level 2 shows you the market makers, and level 3 is the answer here. That's what you need as a market maker to change your quotes. And then level 1 shows you the highest bid and lowest ask, 1 and 3, the inside quote. 91 is very much a test question. That is very much a test question. A market maker fails to honor a firm quote. That's a prohibited practice and is known as, and you got to come up with backing away. That's very testable. I said, what are you going to do about it? You say, do you know the code of procedure? The answer there is C. A good way to get this right is with a mnemonic: order peanuts, Mr. Carter, or order other people's monies count. So the first place it goes is to the order department. The order department is responsible for wiring the order to the appropriate market center or transmitting the order to the appropriate market center for execution. So it's going to go 3. Then it goes to the purchase and sales department, who generates the confirmations, which have to be in the mail test question by settlement. And then it's going to go to the margin department, who determines whether monies or securities are due. Even in a cash account, the margin department does that. And then it goes to the cashiering department, who takes receipt of monies and or securities. So it's going to be 3 4s. We're looking for 3 4. 3. Let's see. Did he miss it? Did I get a bad answer set? It goes 3 1. There we go. 3 1 2 4. Yeah, there we go. A. There we go. The one who generates the confirmations of trades is the purchase and sales department. They're the ones who match the trades. DVP, I just say to you, I don't need you to hold my monies and securities. I have a bank that does do that for me. So when I open an account with you, I want you to deliver my securities to State Street Bank and Trust. That's called a delivery versus payment account. And you have up to, test question, 35 calendar days to deliver. Now, it's not going to take my broker 35 days to deliver the stock to my bank, because my broker wants his money, wants it like now. But the answer to this test question is D, up to 35 calendar days. DVP stands for delivery versus payment. You might actually see this expressed as well on your test as receipt versus payment, or you might see this expressed on your exam as cash on delivery. So a customer didn't mean to sell short. He accidentally sold short. And so to protect him from having an open short position under the customer protection rule, I'm going to buy him back 10 business days after settlement. So the answer to that one is B as in boy. B as in boy. Assignment to transfer, separate sum of the certificate. I said, well, don't send me a fully negotiable stock certificate in the mail, please. No. Signed a stock power or bond power. And when I get that in the envelope, I'll staple it. And so this is assignment to transfer, separate from the certificate. C. I had somebody the other day ask me what a due bill is. A due bill is an IOU to the buyer, and it's on trades just prior to the X date. You think every once in a while we screw it up and somebody, gets a dividend they weren't supposed to? Yeah. Due bill tells the buyer, we know it, we're working on it. Oh, give me a bunch of these, 8.5%. Woohoo. I'll take a lot of those. Right? Give me as many as I can get. 99 is very much a test question. That's called forward pricing, very testable. Be careful on 100. The largest single expense to the fund, not to the customer. The load, remember, is not paid by the fund. The load is paid by, the customer. So the investment management fee. There is a problem with having monkeys harvest bananas. they eat the product. And so, the investment managers are the largest single expense. P.S. the more my expertise, the more I'm going to charge you. So the answer is B. And then remember the load 101, the answer is C. The answer is C. I haven't had anybody in a while tell me they've had to manipulate NAV and public offering prices. That used to be pretty standard fare, and I haven't had people do that as often. But you might have to recalculate this based on the NAV. And the way we do that is we take the NAV and says, let me get my picture out of the way here. I'm going to take the I'm going to get my tool. I'm going to take the NAV, $8.50, and I'm going to divide by 1% or 100% minus the sales charge. And so I get boom. Now, as I mentioned, if you want to get that, embrace math, because there's no, I take 850. I'm just taking my calculator now. And I've used the formula. I just gave you the formula. And hopefully I come up with one of those answers. Boom. Your client qualifies for breakpoint. A breakpoint is a quantity discount. So breakpoints are good. Be careful. Breakpoints are good. Breakpoint sales are bad. Breakpoints are good. So my customer isn't going to pay this. He's not paying 8.5. He's qualified for this. So now I got to recalculate based on I'm paying that. So I do the same thing again. I take $9.15, the NAV, and I divide it by 100% minus the sales charge. By the way, I think this is more likely in a Series 6 top off than anything else. And so let's see, I take $9.15 and I divide by 0.96 and I get 953. Now, again, you want to embrace math though, because there's no, interpretation of a math question. You just either simply get it right or you get it wrong. What was the load? So now I got to figure out what the load is in the math here. Again, this is a little overkill. This used to be pretty standard fare, but I haven't anybody in a while tell me they've had to really do these calculations as much as they used to make you do it. But oh well. Anyways, the way we do that now is we take the 1736, the public offering price, we minus the NAV. By the way, I would tell you on your Series 7, almost all the test is division. So, if you can't decide what to do, hit the divide key. I'd be doing you a favor to mask every key on the calculator except your divide key. And then what I'm going to divide by is the public offering price. And that should give me the load. So let me, order of operations, I'm going to take the 1736 and I'm going to minus the 1650. And that gives me 86 cents. And then I'm going to take the 86 cents. I'm going to divide by 1736 and I get 5%. That's very much a test question. Very much a test question. So, most mutual funds are going to do substantially better than the 90%. The answer is C, very testable. REITs are the same as well. REITs must pass through 90%. Now, REITs, real estate investment trusts, and mutual funds don't pass through losses. That's only a partnership. Only a partnership. And so I haven't, be careful on that. But anyways, most funds are going to do substantially better than this. If I were a mutual fund, I wasn't passing out, 98, 99%. I would get huge redemption requests because whatever money the mutual fund keeps, they're going to have to pay taxes on it. And they would really have to make a good argument to me, the mutual fund shareholder, why they think that is efficient, because it's not. Now, we didn't have subchapter M or the conduit or pipeline theory. What would happen is, Exxon would make money, pay taxes. Well, they haven't been making money lately. Google would make money, pay taxes. Apple's a better example because they pay dividends. Apple makes money, earnings, pays dividends, pays a dividend. I pay taxes. Now, remember that dividend came out of the earnings, so it's been taxed twice. And then the IRS is going to tax me and make it tax 3 times if it was a mutual fund, right? Apple would pay taxes. The mutual fund would collect the dividend from Apple, pay taxes, and I pay taxes. The IRS has been kind enough to say that as long as they pass through 90% of the net investment income, the IRS has been kind enough to say They'll wait and get it from the mutual fund shareholder. I think a great way to remember this on your exam is die 90, die 90. That stands for the dividends on the stocks in the portfolio, plus the interest on the bonds in the portfolio, less the expenses. That would be the way to get that right. Die 90, 90% is what must be passed through. As I told you, most do substantially better than that. I haven't changed this yet for the CARES Act, and so none of those are right. None of those are right. It's now 72, and you should answer accordingly. So I haven't updated this practice exam. Again, it's not any of those are right at 72. 108 is a question. So you earn the variable annuity, and you're past 59 at TAF, and you say, Dean, I want to annuitize. What would be the largest monthly payment? And that would test question be life only. If you tell the IRS that you only want to be paid for your life and your life only, that'll give you more money. 109, type of business ownership, flow through. That's very much a test question. A partnership, a direct participation program. That's very much a test question as a flow through. And by the way, IRS hates partnerships. Why? Because they hate them because the money is flowing through and the tax consequences are only realized once. And so they have to avoid test question at least two corporate characteristics. Now, it's going to be hard for direct participation to avoid centralized management because they have a general partner. 2 is very easy. Partnerships do not have a freely transferable interest. You can't get in or out of a partnership without the GP's permission. So 2 is easy to avoid. Profit motive, you better not tell them you're not trying to make money because the IRS will be upset with you. Continuity of life, partnerships have a finite life. And so the answer is 2 and 4, 2 and 4. Very much a test question. Which of the following are risks of a partnership? Very much. I can't imagine any draw in which you don't get asked about the lack of liquidity. As I said, you don't have a freely transferable interest. Recapture the losses. So you take the tax benefits, you're writing down the asset, then you sell it, and you're going to recapture some money and owe some taxes. Not good. Not bueno. You have an IRS audit. Not bueno. You signed a recourse note, and now the bank is coming after you because the partnership didn't pay back the borrowed money. All those are bad. Again, these questions have been removed to the SIE. That's fiscal policy. I think you're more likely to see that on the SIE than the 7. Again, more likely to see that. That's D on the SIE than the 7. Again, I think you're going to see this on the SIE, not the 7. So I'll probably at some point come in here and redo these questions and write some different ones, but oh well. When the dollar goes down, U.S. exports are more competitive and imports are less competitive, 2 and 4. This is still very much a test question. I would definitely know what defensive stocks are. Regardless of the business cycle, you need your power. For example, utilities are defensive. Nobody wants to go back to the Stone Age. You might cut back on power, but you're not cutting it completely, right? That's called odd lot theory. Odd lotters are people who aren't buying on the normal delivery. I was shocked when I was on the subreddit looking at options and how many people were approved and buying ridiculously low amounts of options. And, Dean, being a practitioner of the odd lot theory, says whatever those people are doing, maybe Dean should do the opposite, right? 118 total stock market is the Wilshire 5000. Dennis Tito's the guy who came up with the Wilshire 5000. He said, I don't know why people always talk about the Dow. It's so ridiculous. I'm going to come up with an index that most closely approximates the total stock market, and that's the Wilshire 5000. By the way, the more likely question on your example in your test is index options on indexes. Both trade and exercise is T+1, and they settle in cash. This rule has recently changed. So now it's just monthly if there's a penny stock, quarterly if not. So just a penny stock. I definitely know what a penny stock is. Let's see if I have that for you. Yeah, this is very testable. So definition of established customer, somebody's done 3 penny stock trades on different days, 3, or had funds with me for a year. So 1 and 3, 1 and 3. Money laundering shows up more now on the SIE than it does the 7, but it's placement, layering, integration. Structuring isn't a stage. Structuring is somebody who's trying to avoid triggering a CTR. So U4 is hello, U5 is goodbye. So you work hard, you get to the registrations. U5 is filed on you if you don't reaffiliate in 2 years. You have to retest. 124 is very much a test question. That's called selling away. Selling away is when you get somebody involved in an investment not sponsored by your employer. And then remember, the code of procedure is when you have a complaint lodged against you. And so the first person you're going to hear from is your Department of Enforcement. My broker-dealer was in District 1, San Francisco. So the first person I would hear from would be the Department of Enforcement of District 1. Now, if I think they've been unfair, I would say, okay, I think you've been unfair. I would go to the National Judiciary Council. They usually uphold the local Department of Enforcement. Then I go to the SEC. And then I go to federal court. All right. Well, I hope that was productive. I'm not sure I'm going to post this or not. I think that options discussion, I'm worried that people might be involved in a explication of a practice exam before they may be prepared to hang with some of the option stuff. So, I don't know how to, determine your suitability to participate in an explication of a practice file. But if I do post it, please give me your comments on whether you thought it was worthwhile or not worthwhile. I have another one that perhaps we could do. Maybe if I do it again, maybe I'll, just buy into the idea that I'm going to lecture instead of explicate. So that would be the other thing I'd be interested in. Would you be interested in, if I do this again? I also have one up where I did it with the SIE practice exam. Were you more interested in explication while we're doing it, or actually lecturing through it, which then it takes a lot of hours and pause, but I'm interested in your thoughts one way or another. Okay. So who knows when this will go? I try and post at least once a week to both my YouTube channel as well as to my subreddit channel. So you can expect that pending kind of things. I still want to do, I got primary market coming, margin, munis. Yeah, I got stuff coming, but tell me what you're interested in. If you have any ideas, I'm more than happy to listen to those and, maybe act accordingly. We'll see. We're on the journey together. So particularly as the YouTube channel, I've been doing, until February of this last year, so 2020, before the pandemic hit, I was very much a Brian Lee dry erase board guy. I would show up on your corporate campus and, do your cohort. I finally gave up my Vanguard corporate campus card and my Schwab corporate campus card because I don't think I'm ever going out to Lone Tree again or going out to Phoenix or Melbourne, Pennsylvania. So who knows? And so in February, live classes stopped and listen, I didn't know how to do PowerPoints and make PowerPoints and use PowerPoints or do distance learning. So I've had a huge learning curve and my students have been very helpful in helping me with that. So anyways, that being said, I plan on, going all in on this distance learning. So been doing distance learning since February. And then my big initiative this year in terms of, a reset based on the current realities of where we're at in the marketplace is part of social media. So start the YouTube channel. January is going to be coming up on 1 month of the YouTube channel and 1 month of the subreddit, and being very active on LinkedIn. So, I haven't figured out all that stuff yet, but I'm still trying to figure it all out. So again, your thoughts would be appreciated. All right. So bon chance, mes amis, and I'll see you on the next lecture from the studio here in fabulous Las Vegas.